Welcome to Money Masterpiece, the explainer, where we really dig into the crucial numbers and strategies you need to know. Today, we're tackling a massive financial move in one of the world's most important agricultural economies. So let's get right to it. The big number on everyone's mind, BDT 39,000 crore. That is the headline figure for the massive new agri-credit plan that Bangladesh Bank has just announced. We're talking about a serious investment that's set to really reshape the entire landscape of agricultural finance in the country. But what does a number like that actually mean? What's the real plan here? And more importantly, if you're an investor, a banker, or an agri-entrepreneur, what does it mean for you? Let's unpack the strategy behind this number for the 2025-2026 fiscal year because it's a detailed blueprint with real consequences for everyone. Okay, before we dive into the nitty-gritty of the policy, we really need to set the stage. Why does agriculture matter so much here? Well, because we're not just talking about a local industry, we are talking about a global heavyweight. You've got to grasp the sheer scale of this to see why this new policy is such a big deal. Just look at these rankings. I mean, it's incredible. Third in the world for rice production, second for freshwater fish, and jute, also second place. This isn't just some regional player. Bangladesh is a critical piece of the global food supply puzzle. This isn't just about feeding a nation, it's about feeding the world. And if we bring it back home, look at its economic footprint. Agriculture is the absolute backbone of the economy. It employs almost half the entire workforce. Think about that. Nearly 1 in every 2 working people. So while its direct slice of the GDP pie is about 11%, its role as the biggest employer, well, that makes its health absolutely critical for the country's social and economic stability. So with that context in mind, now that we know just how important this sector is, let's get into the official plan to give it a real boost. Bangladesh Bank has laid out a formal policy and the objective is crystal clear. So here it is, in black and white. The central bank's official target is that BDT 39,000 crore for agricultural credit. Now, this is a 2.63% increase over the previous year. That might not sound like a huge jump, but what it signals is steady, continued investment and a clear vote of confidence in the sector's potential. But here's the key thing to understand. This isn't just about throwing more money at the problem. It's about being smarter with that money. There are some really significant policy shifts happening, and if you're a banker, you absolutely have to pay attention. The central bank is tweaking the mechanics of lending to get very specific results. Let's look at how things are evolving. See, the old way had optional credit or CIB reports for small loans. Now, that CIB report is mandatory for everyone, no matter the loan size. That's a huge shift. We're tightening things up and reducing risk. But on the flip side, for smaller loans up to 3 lock-in livestock and fisheries, they're simplifying the paperwork, so it's easier access for the little guy. And look at the mandatory allocations. Livestock share is jumping from 15% to 20%. And for the first time ever, there's a new 2% slice just for irrigation and machinery. That's a brand new focus. Another big push in this new policy is something called contract farming. So what is it? Basically, it's a system that takes a lot of the risk out of the equation for everyone involved. A financial institution or a business provides a farmer with credit, seeds, maybe even training. In return, the farmer agrees to produce and sell their crop back to that company. The farmer gets security and a guaranteed buyer. The business gets a reliable supply chain. It's a classic win-win, and you can see why the central bank wants to encourage it. All right, so where is all this money, all BDT 39,000 crore of it, actually supposed to go? Well, the policy is super specific about this. This is no blank check. It's a very targeted investment plan. Okay, take a look at this. The biggest chunk, over half at 55%, has to go to core crop production. That makes total sense, right? It's the foundation of food security. But look at the other bars. A full 20% is now required for livestock, and another 13% for fisheries. This tells you just how important and profitable these protein sectors have become. And this is where it gets really interesting, especially if you're an agro-entrepreneur. That brand new 2% allocation for machinery, that's a massive signal of opportunity. This is all about modernization and efficiency. Meanwhile, you've got this 10% bucket for other activities, which gives banks the flexibility to finance innovative rural projects that don't fit into the traditional boxes. Now, here's a challenge that plagues even the best policies. How do you make sure the money actually gets to the people who need it? A great plan on paper means nothing if the cash gets stuck somewhere in the middle. So let's look at the ground game, how this policy plans to get credit to the real farmer. So they're tackling this from a few different angles. First, they're using agent banking to get into those remote areas where there aren't any bank branches. Smart. Second, there's a real focus on the small guys, the marginal and tenant farmers. Third, they're using those special BDT 10 bank accounts to put credit directly into farmers' hands. And this last one is really key. Private banks now have to push out at least half of their target through their own network, not just by handing it off to microfinance institutions. That forces them to build real relationships within the rural economy. Okay, so we've got the plan, we've got the targets, but how do you make sure everyone actually follows through? It's one thing to set a goal, but it's another thing entirely to hit it. Well, this is where the policy gets really clever. It's got both a stick and a carrot. And at the heart of this enforcement strategy is this, the BBADCF, or the Bangladesh Bank Agricultural Development Common Fund. I know, it's a mouthful. But basically, think of it as a special pot of money designed to penalize banks that slack off and reward the ones that really step up. It's all about powerful financial incentives. So here's the stick. If a bank misses its annual target, it has to take whatever amount it fell short by and deposit it into this fund. And the interest they earn on that forced deposit, a measly 2%. That is a terrible return. It's basically a penalty for not deploying capital where it was supposed to go. And now for the carrot. If you're a bank that's killing it and you exceed your target, you get to borrow from that same fund at that same super low 2% interest rate. So you get access to a pool of really cheap capital funded by the underperformers to go out and grow your portfolio even faster. It's a brilliant reward for success. So you see what's happening here? The BBADCF effectively reallocates capital from banks that aren't prioritizing agriculture to those that are. It's a market-based mechanism baked right into the policy to drive behavior and make sure that BDT 39,000 core target is met. Which leaves us with the big question for everyone, from bankers in Dhaka to farmers in the fields. Will this blend of ambitious targets and a really clever enforcement system be enough to supercharge Bangladesh's agricultural growth? The policy provides a clear framework and strong incentives, but the challenge now is execution. The potential is immense, and you can bet the world will be watching to see how this all plays out.